Let's see. All right, AMT rates. These were always meant to target high income individuals who were paying deferred rates, kind of skirting the higher rates that they should be applicable to. But over time, these exemptions never really increased. So it's slowly started to creep into the middle class, to the point where, my retired father-in-law who did his own return by hand got a notice because he didn't fill out this form. And so it just wasn't it was no longer doing what it intended to do. So the TCJA bumped those exemptions up, and kind of fixed the glitch, so to speak. But, with the sunsetting, all these exemptions are going to go down, and a lot more middle-class taxpayers are going to be subject to this AMT. Is it significant? No, but 1,002 more in tax than you anticipated, is going to hurt. I got ISOs, which you probably don't, not applicable to you. Mostly startups. We got a few startups here, Rivian. I've got some people with DoorDash that these apply to. But again, it's all about accelerating income now, before 2026 kicks in. I mean, the biggest change for 2023, because again, there aren't big changes, is bonus depreciation slowly being reduced, going from 100% last year. We're going to get a 20% reduction over the next 4 years, till it eventually being phased out. It wouldn't shock me if they reinstated this, but so far it's being sunset at the end of 2026. So with the phasing out of bonus, you are going to see Section 179 come back. Are you familiar with these two?
Yes.
Yeah. So you're just going to see, I think, more 179. 179 can be taken on roofs and HVAC, which is typically 39-year property, which bonus cannot be taken on. So there is a perk there, but 179 can't take a business into a negative loss. And there are additional limits at the entity and individual level that bonus depreciation isn't subject to. So, Joe, how are you?
Good morning. Sorry I'm late. I was tied up on something I couldn't break away. Crazy enough. It had come right as this was starting, unfortunately. So
it's okay. I mean, it's just Steve and I, so I'm just
okay.
quickly going through with him. Any questions you guys have, since there's only now 2 of us on here. I mean, as informal as it is, I don't want to waste your time and talk about things you guys don't want to hear. But I also want to answer questions, and help you out with things you were hoping to hear, so to speak.
Yeah, I thought we were supposed to have about 6 folks on the call today, but as it turns out, I was late myself. But anyway,
it happens.
It does, and I apologize. It's hard to get the engagement level sometimes with the membership. I appreciate you coming, Steve. And I see there's another, is Karen on too, or is that?
Tax is very riveting, so
Yeah, I guess I'm the only one.
Okay.
Hey Karen, how are you?
I'm good. Can you hear me?
I can hear you now.
Okay, good.
Yep.
I guess I'm the only one on here.
So Steve and I talked before you guys both got on, and it was just him and I wasn't going to run through this whole presentation just for him. I was just kind of going through quickly cliff notes. But if there are questions, things you had answered, things you wanted answered, feel free to ask.
There's a couple other people here that are supposed to be on. I'm just gonna check with them, see if they're coming on before you get started, because our invitation originally said it didn't start till 12. So just give me just a minute, okay?
Sure.
Okay. Steve, I mean, I can go through this now and you can jump off.
If you want to, we can just finish up the last couple, and I can.
I mean, it's
kind of reset with the other group, I guess.
Our R&D, you familiar with the R&D issues
Yeah.
of 2022? Yeah. Just some miscellaneous changes. At the individual level, the $10,000 cap on taxes is going away. So the Michigan flow through tax will go away. You familiar with that?
No, not really.
All right, so at your individual level, income and real estate taxes were limited to 10 grand. That's going away. But to kind of circumvent that, the state came out with a deduction that the businesses can take to pay these income tax at the business level. So if you're not doing that, I would suggest looking into that for 2024.
Okay.
You have to make the election by March 15th.
Okay. Patrick Ebbing is on too, so.
Okay.
Hey, guys.
Hey,
Hey,
Patrick.
Okay.
So, and then some IRS updates. ERC, IRS is pounding that hard. They stopped processing those. So I don't know if that applies to you. I don't know if you've got your money, didn't get your money.
PPP we got, but we didn't get, again, it's ERC. When I looked at it, it's somewhat nebulous, even though they changed the rules about
They
6
did.
times over the
They
last,
didn't.
so.
Like I said, 2 months ago, they halted processing of everything. And then today they came out with a new process where they're going to allow taxpayers to withdraw their application if they had second guesses. So it'll be interesting to see what comes of this, but I know that they are going after preparers of these returns, as well as companies, as well as the people that did the studies. So they're looking at this hard.
I know a local fabricator here in Farmington Hills, and they had their paperwork submitted for months now on ERC, and they're still waiting to get their money. Is it dead now? Is the program ended?
It's not dead, but like I said, at 2 months, I think it was 2 months ago, they put out a notice saying they're halting all processing of these forms.
Future
They're gonna look,
claims.
even ones that are like in the queue, right?
Oh,
They're
boy.
just they're
Okay.
hitting them because they want to take a closer look at them, just because of all the fraud, right? You've got these companies that you hear them on the radio, you see ads online saying, you qualify, you got supply chain issues, you'll qualify, and that's just really not the case. So the IRS has really cracked down on these. So I'll be curious to see what comes of these for the next couple of years. And with that, you see the IRS implementing, the 80,000 new agents or whatever, but we are seeing more audits of partnerships of S Corps. The use of AI, I've got an audit now. The IRS is going after him because his income report on his return doesn't match the expenses he spent personally. And I have no idea how they figure that out. No idea.
Quarantino bills, or does Linda?
But it just goes to show that AI is coming into play with the IRS, and I think it's going to trickle down to the states. You're going to start seeing states coming after companies. Are you doing business in our state? Do you have activity in our state? You have X amount of sales in our state. You reach the threshold for franchise tax, things like that. So
Interesting.
Okay.
AI is creeping into everything we do, isn't it?
it is.
Well, now that you had your practice run on me, Kyle, you can go on with the rest of your group.
I mean, all right, I'll go back to the beginning.
Yeah, I'm going to drop off.
All right.
All right,
Thanks,
Steve,
guys.
thanks for getting on the
Yep.
call. Appreciate it.
Bye-bye.
All right. So are you guys all from the same company, Karen?
No, Patrick and I are,
Okay.
who Ken is.
Okay. Hey, Ken, how are you?
Good. How are you guys?
Doing well.
Good.
Hey, Ken.
Hey, how you doing, bud?
Good.
Good.
So just to be clear, there was it does say it starts at 11:45. So
Oh, I'm sorry.
we were talking before you got on, Ken. I think there's been a little confusion in the way
Yeah,
these mailings have
I
been
thought it
going
was
out.
11:30.
Yeah, I know.
Mm.
11:30, 11:45, noon. There seems to be some confusion. So I'm going to work with the marketing group that I'm kind of been working hand in hand with on these things to see if we can clean that up a little bit so there's less confusion. When we do the lunch and learns in-house, the way we started here at 11:30, and we ate from 11:30 to noon, and then
Right.
started. And that's kind of how we've been rolling up until
Yep.
this one, because it's being hosted, or it was going to be hosted at Doeren Mayhew today, but it didn't we all only had virtual attendees. So we have to figure out how we're going to do that going forward, because we don't need that eating period
Right.
in there anymore. So
Right.
anyway, I'll let you take off, Kyle, and go
Well,
from there.
I
Start
mean,
with the,
with so little people, you know, as I told Steve, I don't want to sit here and go through things that you don't want to hear that aren't applicable to you guys. And maybe I can answer things that you want to hear and are applicable to you guys.
Mhm.
So with three of us on here, you know, it can be more of a conversation. I could run through this. Like I told Steve, it was about a half hour. It wasn't the hour and a half that I saw on the invite. It can be informal because, like I said, there's only three of us on. So, how do you guys want to proceed?
yeah, go ahead, guys. Yeah.
My opinion is just hit the high points and share the presentation and
Okay. I mean, I that works for me. And like I said, it is, if we are done and you guys have questions, you know, you should have my contact information. It is in this slide. And Joe, you can share this. I can send this to you to send
Please.
out.
Yeah, please.
So yeah, I'll introduce myself. Kyle Zakaski. I'm a tax shareholder at Doeren Mayhew. Been here for 15 years. I interned with them and really spent my whole career with them. So I do a lot of construction, real estate. I do manufacturing. I'd say those three are my bread and butters. We only focus on closely held businesses. At least I do. Partnerships, S corps. I don't do many C corps. I think I do one. We don't do publicly traded companies. We work on saving tax for small business owners. We don't work on, you know, building up EBITDA and getting dividends to shareholders. So, you know, with that said, this presentation was supposed to be on the Tax Jobs and Cuts Acts, all the rules sunsetting. If you guys remember back in 2018, this came out, it was the biggest change, you know, since the 1986 tax law. So it was the biggest change in my career. And everything at the time was taxpayer friendly. You had increased exemptions, increased deductions, decreased rates. You know, you name it, it was taxpayer friendly. And like all things tax, it's timing. So the pendulum's going to swing the other way here in 3 years. So as much as it helped us 3 years ago, it's going to hurt us in 3 years. And so this presentation is just to kind of plant a seed that, hey, you know, as Game of Thrones would say, winter's coming. And we just need to prepare and just start thinking about it.
So if I read you right, then these tax exemptions or tax cuts were just a small window here, and then they go back to where they were.
Yeah, for the most part, it was an 8-year law, so to speak, 7-year law with sunsetting or expiring in 2025. Do I think some of these will be extended? Yeah, but over the past 5-10 years, when a significant tax law is set to expire or sunset, so to speak, Congress is slow to act, right? They will pass a law now, effective 1/1/23, which doesn't help us. You know, it very infrequently have they passed something that allowed us time to plan for something to take effect for 2024. So most of these are going to expire. I do think 1 or 2, like I said, may get extended, but this is law as it is now, and this is what we have to prepare for.
Okay.
So high level cliff notes. Today's exemption for gift and estates is 13 million. It's going down to 5 million in 2026. You know, the phrase, if you don't use it, you lose it, will apply here. If you don't use that exemption by January 1st, 2026, you will lose it. And so what I mean by that is, quick example, you gift 9 million in 2025, that'll be all tax-free. The exemption goes down to 5 million in 2026. There's no clawback in place, which means that 9 million you gave will always be tax-free. And the IRS will not come back after you. If you don't do that in 2025, and you gifted in 2026, you would have a $4 million taxable gift, which is usually taxed at the highest rate of about 40%. So with this, I think you're going to see it in influx in gifts, maybe not necessarily cash, but you'll see business ownerships going from one generation to the next, right? If we're thinking about transferring it from dad to son, dad to daughter, mom to son, mom to daughter, this I think is just going to expedite that transfer.
Yeah, that's what I was just thinking. Yeah.
You don't necessarily need to give up controlling interest, right? You can do voting shares, non-voting shares,
Mhm.
but it is going to increase the amount of ownerships being gifted to next generations, because like I said, if you don't use it, you are going to lose it. So if you're going to do it in 5 years, you might as well just do it in 2 years.
Yeah.
This tab is just kind of a reference tab, nothing crazy here, just 2023 rates, just incremental changes from 2022. So when you look at it from 2022 to 2023, you're not really going to see big changes, just inflationary adjustments. When you look at it, kind of where we went or where we've been to where we're going, you can kind of see a bigger picture.
Oh yeah.
Pre TCJA, you're looking at 40% is the highest tax bracket, starting at about 480 grand. To 2025, you're looking at 37% being the highest tax bracket, starting about 720 grand. So when the TCJA came, you can kind of look at it. It reduced rates in every bracket. It increased lower brackets. It just made it tax beneficial all around to everybody. And then, like I said, fast forward to where we're going, 2026, it's increasing everybody. Every single bracket is going up. So it's something we need to prepare for. And what do? We do what we never do. We think about things we never thought we'd think about. And that's accelerating income and deferring expenses. Typically, tax accountants, we kick the can down the road. We defer income, accelerate expenses. We do what we can to lower your tax bill today, because who knows what's going to happen in 3-5 years. The closer we get to 2026, the closer we're going to have to start thinking about accelerating income and deferring expenses. I'm not sure the business structure of you guys that are on this call, but if you guys are flow through entities, you get that qualified business deduction. That's a 20% rate. So, really that 37% becomes 29.6%. So you're going to have a 10% increase on flow through income in 2026, which is pretty significant.
Yeah.
So, I've got one client who's a dealership who's on the LIFO method for inventory. And this past year, he elected off LIFO, because all LIFO is it's a deferral. You're just deferring income. And so he decided to get off LIFO. And when you do that, you got 4 years to recognize that income. So he's going to be recognizing that income over the next 4 years at a lower rate, because he's afraid of what's going to happen in 2026. You may consider electing out a bonus instead of taking all of that depreciation or as much as you can in these years, elect out and spread those deductions out so that you can take those deductions in years where you're paying higher tax rates. Roth conversions.
I was just going to ask you about Roth conversions. Yeah. Would this be the time to do that?
If you're like, if you're thinking about it, yes. I'm not telling you to go convert all your IRAs to Roth.
Sure.
But if it's someone who's hemming and hawing, maybe I'm going to do it, maybe I'm not going to do it. Now would be the time to do it before it happens. Do you know much about backdoor conversions, Joe?
A little bit, yeah. I'm kind of talking about that with my accountant now, and I have some tax loss carry forward that I was thinking about using to wipe out that tax loss and then just do the Roth conversion. So it might be best to do that now before this changes, it looks like.
Yep. And then going forward, you can contribute to a Roth every year by doing a backdoor Roth, they say. So what you do is you just contribute to a normal IRA on today, and then tomorrow you would convert that to a Roth. It would be completely tax-free. It's completely acceptable by the IRS. And that's just, I've got lots of clients that do it. And I've got lots of clients that don't, but should do it.
But there's a limit, right? $6,500 or something?
Yeah, it's about $7,000.
Is it 7 now? Okay.
And then also excuse me, 529 plans. Are you familiar with those?
Mhm.
MESPs?
Yep.
They came out with a new rule that said, you know, you contribute to an MESP, your child goes to college. If you have leftover funds, you can roll those over into a Roth IRA for your child.
Oh, okay. All right.
So if the 529 plan has been open for at least 5 years, you can roll over up to 30 grand into a Roth IRA for your child. So that's the new rule. And I think that's pretty significant.
It is.
This to me is the biggest change, as I touched on prior. The QBI deduction is going away. Before QBI, we had DPAD, which wasn't as significant. So this going away is huge. It's like I said, it's bumping the highest tax bracket up from 29.6 to 39.6. And losing a 20% deduction is pretty significant. It's just going to make you question, you know, should you be a C Corp? The answer is probably not, but if you're in a period of growth, if your goal is to grow it and sell it, you know, a C Corp might be the more beneficial structure for you, because you're not pulling out cash, you're not being double taxed. The tax rate's 21%. It's a lot less than 40%. So some things, like I said, that you haven't considered, you're going to want to start to consider.
Yeah.
AMT rates, these were, the AMT tax was initially enacted so that higher tax individuals paid their share. You know, you weren't making $3 million and paying 10-15% because everything is qualified dividends. But as time went on, these exemptions were never adjusted for inflation, so it just kept impacting more and more middle-class taxpayers. So the TCJA just fixed that. It put it back to what it should be. It gave some middle-class taxpayers relief from this AMT. You know, it's not significant, but you know, a couple grand, couple $1,000 to someone that makes 80 grand, that's pretty significant. So with the sunsetting of it, these exemptions are projected to go back down, and I think that's going to hurt a lot of middle-class taxpayers. And this is one thing that I do think will get fixed. But, you know, like I said, as of right now, we just have to proceed forward as if it's not. So back to the accelerating of income, it's ISOs. I don't know if these apply to anybody here, so I'm not really going to talk too much on these. These are mostly, you know, startups, publicly traded companies, you know, how they reward their employees, and just ways to exercise those now under a lower tax rate versus waiting and being subject to the higher rate. So the biggest change that's happening now and over the next couple of years is bonus depreciation going away. Bonus depreciation was 100%. Any asset you purchase pretty much under 20 years, you could immediately write off. You can take your business into a loss. It made everyone's life easier. You didn't have to keep track of depreciation too much. You didn't have to ask too many questions. It was nice because you could just write it all off. But now, as it's being phased out, everyone's gonna have to start keeping track more accurately of their fixed assets. What is the asset life? What exactly was it? Because it's not going to be not going to be able to take bonus depreciation, but you will be able to take 179. There are limits on 179. You can only take for 2023 up to 1.2 with an investment limit of 2.9. All that means is if you start putting fixed assets into service over 2.9 million collectively, the amount of 179 you can take is reduced dollar for dollar over that limit. And that limit is calculated at any level in an individual level. So if you've got an individual that has 4 or 5 K1s, you're going to want to coordinate this with them, because if they get 4 K1s with $1 million on it, you're only going to be able to take 1.1 million, and the rest of it is just going to be gone for good. So it's something that should be considered, needs to be considered, and shouldn't be overlooked. The good thing about 179 is you can take it on real property. So roofs and HVAC, you can immediately write those off, which is something bonus you could not do. And then, like I mentioned before, 179, you cannot take your business income negative, which is something that with bonus depreciation you could. So you're just not going to see too many NOLs being generated now with bonus being reduced, and 179 coming back in vogue. R&D changes, you guys being tooling, I assume you guys already felt this impact. It started in 2022. It didn't matter whether you claimed the credit or not, but you were required to capitalize R&D expenses and amortize them over 5 years, but it's really not 5 years, it's 6 years, because you take 10% the first year, 20% the next 4 years, and then 10% the year after that. There's a lack of guidance as to how this interplayed with the credit. Do you take a full R&D credit? Do you take a reduced credit? There was also hope by CPAs and taxpayers for the entire period of 2023 that they were going to retroactively change this all the way back to 2022. That didn't happen when all the returns became due. So we're sitting here hoping, waiting, wishing that they retroactively fix this back to 2023, January 1st. I don't think it's going to happen, but you can hope. So it hurt taxpayers. The R&D credit was there to incentivize R&D. With the add back of all these expenses, you really lose that incentive. Just some miscellaneous changes at the individual level. The $10,000 cap on taxes is going to be removed in itemized deductions, which means all income taxes and real estate taxes will be deductible, which means the Michigan flow-through tax entity will no longer apply. The Michigan flow-through tax was enacted 2 years ago to counteract this cap, and was placed in this, or only effective as long as that cap is in place. So if that cap gets removed after 2025, this Michigan flow-through tax will no longer apply. If you guys are a partnership or an S corporation and you aren't doing the flow-through tax, I'd ask your CPA to prepare why you aren't doing that, because to me it's just a deduction that you're missing out on. The mortgage interest limit is going back up from $2 million from $750,000, and cash contributions are going to change from 60 to 50, which means you can only contribute up to those amounts. I very rarely see that, but I just want to put this on there just as an FYI. And another big change for businesses is meals go back to 50% being deductible. Over the past couple of years, you could deduct 100% of your meals. So I've had clients that maybe were lacking in their record keeping because all meals were deductible. Well, in 2023, meals are now 50% deductible. But company meals, company picnics, those sorts of things are still 100% deductible. And IRS updates. I think everyone was on for this when I talked about the first time with Steve, but the ERC is something the IRS is focusing on. They've halted all the processing of those. They are increased the scrutiny in these because of all the scams, all the fake companies, all of the aggressive approaches that have been taken with this. As of, like I said yesterday, they came out with a process that allows you to withdraw your application if you've given it a second thought and you think you no longer apply. So I'll be curious to see what happens with this as they go after preparers, taxpayers, and the producers of the studies. And along with the ERC, they are also going after pass-through entities. Pass-through entities, I think they audited them at like a 0.03% over the past couple of years, so pretty much next to nothing. So they are looking at pass-through entities. They are looking at higher income individuals. And as I mentioned, they are using technology and AI to kind of detect tax evasion, detect red flags, detect, in my instance, they told me that my client's expenses do not match his income. Looking at his return, I didn't see a red flag because he was in the real estate industry. And I compared him to Donald Trump, right? Who's a billionaire and paid next to no taxes. So to me, what he did, it wasn't a red flag, but the fact that they were able to say that the cars, the purchases he's made didn't match the income on his return, to me was surprising. So I do think this is an area that is only going to get better on the IRS's part. And I do think, like I said, it's going to go down or trickle down to state taxes, to where they're going to be able to focus on companies and determine all the sales they have in the state. If an employee stepped foot in the state, did they have physical nexus? Did they have sales nexus? Should he be doing sales tax? I do think that's an area that's just going to become more and more taxed in the future. So I mean, that's the Cliff Notes version.
Thank you.
Do you guys have any questions? Is there anything you were hoping to learn that I didn't cover? Is there anything that I went over that you guys had questions on?
Kyle, can you go back to the tax bracket slide?
This one?
Yeah. So TCJA, and I'm sorry, I'm kind of learning all this terminology.
Okay, so TCJA is just the tax. It was the name of the tax law that was enacted in 2018.
Okay.
So all that means is, the first column was before this tax law was enacted. The second column shows you the changes that happened in year one. So you could see the immediate tax savings that was occurring when you go from those two columns.
Right. Okay.
Okay. So the middle two columns now say this is where TCJ started, but each year the brackets get adjusted for inflation. So each year they kind of get bumped up a little bit. So now you can see where we started to now where we're gonna go when TCJ ends in 2025.
Okay.
So right now in 2023, we're probably right here, right? With these rates, we're probably right here. And then when TCJA goes away, you're going to see these immediate changes. So you're going to
Got
see
it.
that this rate is coming into play a lot earlier and at a higher rate.
Got it. So yeah, interesting. And that starts January 1st, 2026.
That's correct.
And when these things happen, you had mentioned that a lot of times things get changed and corrected. I mean, how likely, okay, if the current administration, stays in, it'll probably go through. If a different administration comes in, it's possible that this will be all completely changed, right? Like, isn't it administration by administration?
It is. And it is. So what I would think would be the rates may go back, but you might see that qualified business income deduction still stays. You might see things like that.
Okay.
You're right. It is administration by administration, which makes it tough.
Yeah. Interesting.
Because like I said, there was a lot of changes, I think 3 years ago, where we were waiting. It was related to COVID. There's a lot of uncertainty, and it would be November 1st, and they would make a tax law change effective 1/1. And it would just make it hard because you can't plan.
Yeah. It's ridiculous.
It's our government.
Yep. Okay, that's all I was curious on.
Yeah, so for a lot of the baby boomer generation owners, company owners out there, it behooves them to try to get something going here in the next year or two.
Well, yeah, I mean,
avoid some big tax hits.
It's either gift it, right? Gift it while you can, or sell your business. Sell your
Yeah,
business.
yeah,
at
whatever
a
your
better rate,
your succession plan is telling
right.
you. Yeah,
It just might accelerate your exit plan,
for sure.
because the amount of taxes you save by selling 2 years early, might be worth
Okay,
it.
I have a question, and maybe this is a borderline because we're actually buying the business in the next couple of years. Well, starting next year from my dad and uncle, my cousin and I are.
Okay.
Would it be more advantageous to do a gift of the business and then we gift them back, the equivalent of what we're buying it for?
Without knowing anything, I'd say it all depends, right? It'd be more advantageous to you, right? Because you get the business, you don't pay anything for it. But then you gift your dad some money over the next 5 years as the business earns income, right?
Yeah.
It's essentially him getting his proceeds. You could do that, but you could.
Does it toe the line of acceptable, or is that completely
It-
acceptable?
It's completely acceptable if you file gift tax returns, right? Because you've done nothing wrong. You are entitled to do that.
So it would completely save on any taxes involved in that paying
on
them
your dad's part, right?
on their part.
Right. But you would be gifting, and I don't know how much, to your dad in reduced when the exemption is reduced. And I know it might be 5 million. I don't know anything about your business, but even if it's not 5 million, you are eating into your lifetime exemption, which
What is the
you-
lifetime exemption?
So in 2026, it's going on to 5 million, which means you can only gift $5 million for your entire life tax free.
My wife and I can.
So it's 10 million each. 5 million, 10 million for a married couple. And
10
so
million for marriage, but
if
right.
you end up gifting your dad $3 million, you're gonna be left with $7 million. And it just eats into your estate. So if you acquire income throughout your life and you're left with a $15 million estate, it just reduces your exemption at that time.
Interesting. But what if it's 12.92 per person today?
Yep.
And if you gift up, next year in 2025 up to 12.92, you're fine. But then going forward, I would have no more gifting ability.
That's correct.
Now, what
Yeah,
if I
tax-free.
gifted up to 5 million? Then we'd only have 5 million left going forward.
You have 0 going forward. So
Well, my wife would have 5
your
million.
wife would have, yes, if you're looking at, yes.
Wow, that sucks. That's
Patrick.
wild.
Patrick, it might behoove you to have a conversation, with your dad and your uncle and your cousin, try to figure this out, because those are big numbers you're talking about there.
That's really interesting. Okay. Appreciate that.
And like I said, your dad and your uncle may want that money now, right? But
Mhm.
that's just something you guys got to work out.
Yeah, I mean, we have a 10-year buyout anyways.
Okay, well, there you go.
Okay. That's food for thought for sure for me.
Yeah, but if when you do a gift of a business, you are going to need to get a fair market valuation done, and attach that to the gift tax return.
Right.
Kyle,
Okay.
Yes, Ken.
I don't have any questions. I'm gonna get off the presentation here. Want to say thank you. I appreciate it. I'm no tax expert. But definitely keep you in mind here, and just want to say thanks. So,
Well, thank you, Ken. I appreciate that. You're welcome.
hey, Patrick,
Yes,
your dad John or is your uncle John?
that's my Uncle John.
Okay, well, when you see him, tell him that Ken said hi. He'll know who it is. So,
Yeah, will do, Ken.
you guys, everybody have a wonderful day. Okay.
Thank you too, Ken.
Thanks, Ken. You too.
Thank you.
Yep.
And I'm going to exit as well. Thank you very much.
You're welcome. Thank you, Karen.
Yeah, likewise. I got 12:30. Thanks, guys.
All right. Thanks,
Bye, guys.
Patrick. Thanks, Karen.
Yep. Bye-bye.
Bye.